Did you know that even the best traders in the world lose trades? Their secret to success is not trying to avoid losses. Their secret to success is trying to manage these losses. In this video, I'll be explaining you the importance of a risk management system and with that ensure that you can succeed in the long term. So now let's have a look at risk management. The definition of risk management is that it involves identifying, assessing, and controlling the potential losses in trading to protect your capital. Because let me tell you something, in trading, losses are unavoidable. Everyone is going to take losses. We just have to make sure that these losses do not impact our long-term sustainability in trading. The goal is to minimize losses while maximizing potential gains. This is what I previously explained with the risk to reward. This is ensuring that no single trade or series of trades can wipe out your trading account. Because what some people do is just take on too much risk that once they lose a trade, this can infect their entire trading account and wipe out an account with one single trade. And that is something you should avoid at all costs. So proper risk management is the foundation of sustainable trading. Without it, even the best strategy can lead to significant losses. So the primary purpose of risk management is to protect your capital, ensuring that you can continue trading even after losses. Trading is a marathon. It's not a sprint. So what we have to ensure is that we can sustain in trading even after a series of losses and that this is not going to affect our long-term sustainability. Even a series of losses should not affect you mentally, and also your account balance shouldn't be affected too much if a risk management strategy is applied. We want to survive these losing streaks, so effective risk management allows traders to survive inevitable losing streaks. So even myself, I'm trading for over 5 years, but I will experience losing streaks. That is very normal in trading, but I have to be prepared and my risk management has to be on point that these losing streaks are not going to wipe out my trading account. So let's now have a look at the core concepts in risk management. So one thing you always have to be aware of is the risk per trade. So you want to determine the percentage of your capital you are willing to risk on a single trade. So for me, for example, that is going to 1 or 2% of my entire trading account. So let's just say, for example, I want to take a long trade on Bitcoin down here. This is going to be my stop loss. I have identified a stop loss of 3%. Now I have to adjust my position size in a way that when I get stopped out of this trade, I am not risking more than 1 to 2% of my trading account. So let's have a look at a simple example and say we have a $10,000 trading account. Okay, so $10,000 in the trading account. If we risk 1% of this, that means for each and every trade, we should not risk more than $100 because $100 is 1% of this 10,000. So in this entire zone down here, if we are stopped out of this trade, the maximum loss should be minus $100. And this is something you have to be aware of because you have to adjust your position size according to this. Say, for example, you're trading on a very large position size. This can mean that you can wipe out your entire account if the position size is not correctly chosen. One thing which a proper risk management can help with is reducing emotional stress. By managing risk, traders can reduce emotional stress and make more rational, objective decisions. So say, for example, you're taking a trade and you are in fear that this trade, if you're losing this trade, it can wipe out your entire account. You will be much more stressed as opposed to knowing the maximum loss is going to be $100, which is 1% of my trading account. That is not the end of the world. It's not going to affect me over the next days. So this is something that you have to take into consideration when it comes to trading, because the emotional stress is something we should not underestimate. And in order for us to achieve that we only going to lose this amount, we should obviously have a stop loss order. So down here, I have to place a stop loss, because if I'm not placing a stop loss and price is just continuing to drop and moving lower and lower without a stop loss, my even predefined risk, because I wanted to close this trade down here, but I didn't because I didn't place a stop loss order, my loss is just going to increase and increase and increase over time. And then you will get to a point where you're like, yeah, should I now just stay in this trade? Should I close this trade down here for a much larger drop? Or should I wait for price to reverse? Maybe I can get out at break even. This is something you want to avoid at all costs. Let's have a look at how to avoid common pitfalls in your risk management. So ignoring stop loss orders is one of the worst things you can do. So what you want to make sure is that whenever you place a trade, there is a stop loss in place and you do not want to move the stop loss. The only thing you are allowed to do is to trail your stop loss higher to reduce the risk. But what you don't want to see is price moving towards your stop loss and you are thinking, oh, I don't want to be stopped out of this trade, so I'm just going to adjust my stop loss. That is nothing you want to do, and this is something that should be avoided at all costs. Another thing in risk management is over trading. So taking too many trades or risking too much capital can increase exposure and lead to burnout and mental stress. So we don't want to over trade. Maybe it even makes sense to set a trade limit per day. So for example, when starting out, a good trade limit per day is 3 trades. That ensures that you won't take too many losses, but that also ensures that you will be very selective with your trades because you already know when entering a trade that you only have 2 left. So 3 trades max per day is something one can start with. So now let's have a step-by-step look into how to implement a risk management plan. So step 1 is define your risk tolerance based on your trading goals and capitals. This risk management is different for each and every one of you because each and every one has a different capital, so we should use a different risk management strategy. Step 2 is create clear rules for position sizing, stop loss levels, and risk to reward levels. Step 3 is monitor and review your risk management plan regularly to ensure it remains effective. Now, let me explain this point because it's very, very important and might be confusing. So say, for example, you started on a $10,000 trading account. That means 1% risk is 100, as we already saw previously. But now let's say, unfortunately, you've taken some losses and your trading account is now sitting at $5,000. So that means your risk per trade should be adjusted to $50 risk per trade. Because if you're still trading with $100 risk, that is double the amount of risk according or in relation to your account balance. Now for the positive part, or for the best case scenario, this can be, say for example, you doubled your account from 10,000 to 20,000. Now you can allow yourself to risk a little bit more. That is going to allow you to have exponential growth over time, because whenever you double the risk, the potential reward is also going to be doubled. So this is why some P&Ls can have these exponential increase. Okay, this is very important and something you want to check regularly. For me, for example, I'm doing that on a weekly basis. And step number 4 is stay disciplined and follow your plan consistently, even during winning or losing streaks. So something some people struggle with is that even on a winning streak, you should not increase your risk. So you might feel hyped, you have taken very good trades, you are on 10 wins in a row, but that doesn't mean you should increase your risk. You should stay very strict with your risk. And even when I'm on a very large winning streak, I'm taking a break because I don't want to get greedy and I want to apply good risk management. So this is one of the formulas that I have created for myself. And to summarize, risk management is a critical component of trading that helps protect your capital, reduce emotional stress, and ensure long-term success in trading. So I hope you can follow a good risk management strategy to ensure your long-term success in trading. So I hope you now understand the importance of risk management in trading. And if you are already a more experienced trader, maybe to reflect on your own risk management system. This is what's going to ensure your long-term success in trading. As you know, I'll be delivering 2 of these videos every week, so stick around, follow and like these videos to not miss the next ones. Goodbye.